Mahesh Patil, CEO and CIO at Aditya Birla Sun Life Mutual Fund, who's joining us on the show right now. Mahesh, good morning to you.
Yeah, good morning.
And what a day to join us on. Markets seem to be extremely skittish. It's the global cues that are causing the scare. You've got the US Treasury yields at the highest since 2011. Currencies are under pressure. There have been mutual fund redemptions. I mean, I can just go on. What's your sense, and how do you probably make sense out of all this?
Yeah, so I think we had our own problems, right?
Yeah.
I mean, the liquidity squeeze, what we have seen, and the crisis in the financial services sector. And I think the global macro, I mean, Indian macro has been deteriorating now for some time. And we've seen some kind of a pressure, but I think with global also turning a bit negative, I think it added to the woes. And I think, yeah, I think near term looks a bit challenging. Yeah, we've seen the broader market actually correct quite a bit. So the pain in the broader market is to a large extent been there. If you look at the small cap index, for example, that is down 39% from its peak, right? And clearly it's a level where value is emerging over there. But the Nifty, the broader market was correcting a bit slowly, but I think with the global backdrop, okay, what we are seeing a sharper correction over there. I think could be some more pain point over here. And yeah, I think from investor perspective, I think it's both on the debt side as well on the equity side, they have taken a hit, right? So all the asset classes actually haven't done well year till date if you look at it. So, but I would say that, yeah, I think things should settle down, okay, could precipitate further in the near term. I think we've got elections and other stuff which are there in the back of the mind. So the markets could not really go up too much. Some downward bias is likely, but I think on the liquidity side, domestic, I think we are seeing some measures taken by the government to infuse liquidity. And I think that should rest some of the concerns, okay, which had cropped up on the domestic side. I think global cues are something which we need to watch out how things, the global markets have been, I mean, US has been at an all-time high. Only yesterday we saw some kind of correction over there. So if at all we see further sell-off in the global markets, I think Indian markets could follow that.
Which was going to be my next question to you. We've been doing what we've been doing, and the kind of sell-off that has happened in the last, 7 odd trading sessions has been when the US markets are making their peaks. So we've still not seen a correction in the US markets, which we tend to tail. So if that actually happens in a meaningful way, how does one arrest the downside? Or whether you could probably arrest the downside?
Yeah, so if the global sentiments turn weak, or there is a kind of a risk off globally, obviously it will impact all the markets, the emerging markets especially, and India also. So yeah, so I think in that backdrop, I think we might see a further leg down over here. However, I would say that the emerging markets in general have seen a lot of pressure on the currency side, and the markets have corrected. So as the local markets correct and the currency is also correct, I think it starts to looking a bit attractive, right, in dollar terms for dollar investors. Yeah, but yeah, on the backdrop of global weakness, yeah, there could be more reaction, okay, which we could see. I mean, unless we see some of the macro, like oil starts to again come back, because that was one of the reasons why Indian markets started to correct in the first phase itself. So if those turn around, then I think probably we might not fall to that extent and get some kind of not exactly dealing, but the fall would be much lower than what happens in the US.
And the likelihood of that happening, I mean, talking about
I don't know. I mean, very difficult.
Already.
Yeah, it's difficult to say, because oil, also the near-term pressure is on the upside. Though it's not, the longer-term view on oil is not really that it should be above $80, but for the next 3 months or so, the upward pressure could remain as how Iran really, sanctions on Iran play out, and whether that supply from Iran goes out of the market totally, or there is some kind of supply coming in. I think that will determine where the oil prices settle down. But I would say the India domestic story is still fairly good, though because of the liquidity squeeze and the rise in the interest rates, there is some fear that it could impact growth, right? So we have not seen that. I think this last month numbers were not that great, but especially for the consumer goods or the auto numbers. But I think this time the season is festive is a bit late. So one has to watch and see how this demand is, because if the domestic numbers are coming in fairly good, and that's what we expect on the quarterly. Last quarter was also a decent quarter. I think then you should find some, market should find a support, I think, after the decent correction what we have seen. So So earnings growth should, at least in the near term, look fairly strong. We're not seeing that really cut, and rupee depreciation also doesn't really impact earnings negatively, right? Because if you look at the Nifty, rupee depreciation actually adds to the earnings growth, at least a few percentage points, because a lot of these stocks are positive because of the rupee depreciation.
Yeah, Mahesh, I think the counter argument that some people are making, and good morning and thanks for being here.
Yeah.
The counter argument that some people are making to this is that because of the suddenness and the swiftness of the fall, we could see some mark-to-market or impairment losses coming.
That's true.
Which in effect, while we can argue that they are one-offs, but they will have an impact on the EPS. Is the threat of the 18 to 20% EPS growth under question right now?
Yeah, you're right. I think the sharp fall in the rupee can have a kind of a loss in terms of translation loss on the either on the forex borrowing, which the companies would have. Some of the companies show to the PL, others adjust it to the balance sheet. So to that extent, there could be some impact on a few companies over there. So given that, there could be marginal. I think the worrying sign is that some of the companies, like in the auto space, for example, where we could see some margin pressures because the commodity prices have gone up. The demand environment, while it is good, it's not as great. So ability to pass on the price increases can impact margins. So there could be some downgrade to earnings. I think the consensus is still at around, if not mistaken, around 19%. Yeah, Bloomberg consensus around 19-20%. We are at around 16-17%.
For your portfolio?
No, for the Nifty. For the Nifty.
Not our universe of companies.
No, not our universe. For Nifty, our expectation is around 16-17 because we think there will be some downgrade to earnings. Say on the, telecom already has seen cement, you could see some downgrades over there. But I would agree that there could be slight downgrade to the earnings, but not too much. At the moment, I wouldn't say that. 14-15% still looks to be a reasonable estimate, even with the current scenario.
Okay, so my follow-up to that, and just before that, I just want to mark a couple of names. By the way, Reliance Industries is now down 4.5%. So there is some perceptible weakness out there in Reliance Industries, which is down about 4.2%. And IT, for a second in a trot, is now correcting. Tech Mahindra is down 2.5%. TCS down about a couple of percentage points as well. So keep those at the back of your mind. But Mahesh, just a follow-up to that. So we are at about 17.5 times with an assumption that earnings will grow 18-19% in the year. If earnings were to grow at 15%, let's say, then we are arguably trading northwards of 18.5. Are you comfortable assigning that multiple to the markets with the macros looking the way they are? Or would you believe that the natural multiple in such a scenario should be a couple of notches lower?
So I would say that, the multiples can be a bit deceptive, especially because the composition itself, if you look at the historical levels, there has been a big change in the Nifty composition in terms of the no, not financial, but the non-cyclical sectors. Their composition has increased almost by 10 percentage point compared to 10 years back, right? So when I say non-cyclical, that includes amongst the financials, it will include the private bank, the retail private banks. So which normally has a slightly higher multiple. I would say, still looking at the current macro, it might still, purely on a P multiple basis, it might still look a bit, market not exactly cheap, at least the Nifty is what it would come to. But clearly if the growth indeed is around 15% or so, and it continues to sustain that at least for not this year, but also for next year, because once the trajectory comes in, it should be able to do that. Then I think the market is at a reasonable level, I would say. It's not very expensive. It's corrected quite a bit now, okay, and earnings have caught up a bit, right, because which was absent last year. So they are catching up. So the forward multiple is now within a reasonable range, as you said, around 18.5. Probably it could be another 5-6% down from here, where it will start looking attractive.
Mahesh, in terms of you said the broader markets, the kind of correction that we've seen, likely so. But even in the run-up on the index, when year to date we were still up 10%,
right,
it was the contribution of a few heavyweights on the index which drove the markets up. So it wasn't a broad-based rally in any case when the markets moved 10% higher. But the sell-off now seems to have exaggerated more in the broader markets without that leg up coming in from the previous session. So in all, from the broader market perspective, the lucrativeness, is it more right now? Because they anyways didn't contribute in the run-up. They've witnessed a bigger sell-off. So things have got really cheap down there.
Yeah, clearly, I think we are seeing good value emerging in the market, okay, at stock-specific level in some of these, the broader market, except from the Nifty. And that's where I think this is a good opportunity for money managers to really identify stuff, because these kind of corrections provide you opportunities to get good companies at a reasonable valuation, or even attractive valuation, I would say. And that opportunity is clearly there. Obviously, because of the recent, the weakness in the market and the negative sentiment, some of these stocks are not necessarily the favorite or the large nice stocks.
Because everyone wants to be in high quality value stocks. They don't want to look at mid cap right now because.
So for a long term investor, there is clearly value emerging in the broader market. As I mentioned earlier, the small cap index is already down around 39%. And it's not as if the earnings are getting significantly impacted over there. Okay, we have not seen that to a large extent. Obviously, quality will have to be differentiated within the small cap space, but companies with good earnings, visibility, good management, stable business, I think this is a good opportunity really to build a portfolio over there with, say, next 6 months, 9 months might not be that great, but this is a time to really pick, if you have the conviction in your investment, I think this is the time to really look at some of these stocks. And that's how some portfolio churn or transition is likely to happen in this, and that's in this kind of a correction. Normally, a correction provides a good opportunity to really do some kind of a churn in your portfolio and to look at stocks, okay, which are beaten down, okay, which are well below their intrinsic value, and I think it's a good time for money managers to generate, not in the near term, but build a portfolio so that you can generate good alpha in the medium to long term.
Would that be your first port of call, Mahesh? Because the reason I asked that, because a lot of large caps and high growth large caps have also corrected 25-30% for various reasons.
Yeah, right. So it's not necessarily the mid cap and small cap, but within the large cap space also, there has been a big divergence, right?
Yeah.
So we have seen some of these, especially the Nifty, whatever, next 50 as they call it, right? Which is all the large cap stocks besides the top 50 stocks. There also we have seen a good correction year till date, and there could also be an opportunity in those names.
If you're heavy in your portfolio on, I'm going to split financials into pure play banking and NBFCs. So in a portfolio which is a little bit heavy on a combination of financials, how should one approach?
So again, within the financials, clearly there will be a split. Okay, now with some kind of a liquidity crunch and we've seen interest rates go up. Within the financials, on the bank side, banks with good liability franchise would do well, right? Because the cost of funds would be lower. And with some amount of retail, I think will continue to show a decent growth. But even the corporate banks, okay, private corporate banks, we've seen while we're still not out of the whole credit crisis, but I think bulk of it has been priced in. And I think over the next 2 to 3 years time frame, I think they should be able to come out with lower credit cost over the next 1 year or so. So that's the space, while private banks with good liability franchise, select corporate banks, okay, again with a strong liability franchise and which have done a lot of restructuring and cleanup, I think should look good. And on the NBFC side, again, there'll be some clear differentiation over there. We've seen the recent correction, the valuations have come off, but again, there NBFC with a strong pedigree and a parentage, I think should not be able to have challenge accessing and getting funds. And on the asset side, NBFCs, okay, which have got some amount of pricing power, and where the NIMs are significantly higher, I think they should be able to take the increase in the rise in the cost of funds in their stride. Some pressure on NIMs, growth will slow down a bit, but with the valuation correction, I think they should, they would emerge stronger. I think they will continue to get access to funds. So there'll be clear differentiation between the NBFC space. And then we have the insurance companies and the asset. So there, I think should show a steady growth. Again, insurance space also has seen a good correction. Clearly, there is good value emerging over there because, they are more steady performers, right, compared to some of the other cyclicals. So around 15-16% growth is quite possible. So that's how one would try to look at the overall banking and financial services sector space.
Interesting. This is not official data as yet, but a couple of sites are reporting about the mutual fund flows in the month of September, Mahesh. You would have some idea about what's happening in your fund as well as the broader space. This outflows that we've seen in the liquid and the USTs, do you reckon these will be isolated for the month of September, or is it difficult to predict that? And if these outflows continue, what kind of problems do they pose?
So normally the September month is a period where you see outflows, okay, because of corporates, okay, because of advanced tax payment. So it's a kind of some seasonal factor, okay, which is there in that. Obviously, because of the current credit crisis, okay, and some kind of rumors, people are a bit weary and would have pulled out more. But I think that should settle down, I think, in this month. Don't see, and liquidity again is being infused. Okay, RBI has taken certain measures, and they should see taking certain measures again, providing some window for mutual funds, okay, repo window or something to really access liquidity if it is required. So that should allay some fears over there. And ILFS also, I think government is come in and taken control over there. So I don't see a large outflows. Obviously, there will be some concern on the credit side because this liquidity crisis is leading to some kind of a credit crisis in a few sector or a few stocks, I would say. So you might not see big inflows at least until clarity emerge in some of these on the debt side. But I think the outflows should get curtailed. On the equity, we've seen a good inflow last month, though there were apprehensions that flows would slow down. My sense is that this month you could see some moderation of flows over there, looking at the current market scenario, and a lot of noise around. But yeah, so I think we had around 9,000 crores of overall equity flows, including your ELSS, equity funds, and the balance fund put together. That number could slow down in the month of October. We have to wait and watch.
Just one last question from me. Tomorrow's the RBI policy. I'm not going to ask what to expect from the RBI policy per se, but any one or two critical news flow points or data points or indicators that you are closely and keenly watching out for?
So I think current scenario, what has happened in the financial markets, okay, where we've seen liquidity has been tight over there, and also the NBFCs, okay, there have been some pressure over there. So I think you should see some kind of indication over there what RBI's view is, okay, on this scenario, how they plan to ease the liquidity situation going forward, and some kind of a window if provided to address the current need of the hour, okay, which is there, because there is a lot of crisis of confidence which is there. People lending to each other are not so comfortable. So I think if there are some steps taken to really address that near-term challenge, I think that is something key thing to watch out in the RBI policy, besides the normal outlook on interest rates.
Okay, on that note, Mahesh, Patil, thank you so much for taking the time out and being with us today. Really appreciate your time.